The world is moving, not in straight lines, but in shifting currents. The US market is recovering, but not evenly. Corporate profits surge, yet paychecks are lagging. This divergence is disinflationary, giving more room for central bank policy easing. In a K-shaped US recovery, selecting quality investments is key. Geopolitics and technology continue to reshape how capital moves and where opportunities arise. Artificial intelligence has moved beyond promises, and debt-funded investments with no proven returns are no longer rewarded. The next chapter of AI is physical intelligence, where demand is shifted from software to hardware. Opportunities emerge where supply is limited. A tripolar world is emerging as the US and China move through distinct cycles, with many countries straddling in between. 2026 is a global story with a focus on emerging markets Asia. China's global growth is reshaping sources of corporate earnings, and a competitive currency continues to support exporters. In Singapore, the financial market is entering its reform window, aiming to deepen liquidity, unlock value, and improve shareholder returns. How should your portfolio be positioned in this global divergence? Let's hear from Kelly, Head of Investment Strategy, share more about UOB Private Bank's portfolio strategy for first half 2026.
Hi everyone, and thanks for joining me. Today isn't just about where growth is, it's about how uneven it will be and whether your portfolios are built to handle it. Here are three key themes and what they mean for positioning. First, the US economy is K-shaped. This favors extending bond duration to capture more yield. We're also focusing on resilient sectors, especially niche consumer names that hold up even when demand splits. And we're avoiding deep cyclicals tied to global trade, tariffs, or lower income spending. Second, AI is shifting from hype to real monetization. We are steering clear of speculative, overpriced names. The real opportunities are in hardware and structural bottlenecks. Semicon chips, sensors, batteries, and specialized manufacturing, where demand is rising faster than supply. Third, growth is broadening globally. China remains competitive with strong momentum in EVs, high-tech, and internet platforms. Across emerging Asia, the outlook is strengthening, and Singapore is well-positioned to benefit from reforms and rising capital inflows. With these themes in mind, let's now turn to asset allocation. We stay overweight equities, supported by Fed easing and a steady economy. In the US, it's not only about mega-cap technology stocks, we also like financials, industrials, and healthcare. We remain neutral on Europe and focus on defense, banks, and industrials. New tariffs can derail its already low-growth economies. In Asia, we stay neutral on Japan as the Takaichi trade really appears quite shaky now. We are overweight emerging markets Asia, especially in China, with tech and dividend plays, along with Korea and Taiwan that's riding the AI wave. And we continue to like the Singapore market with corporate reforms that can re-rate valuations. For fixed income, we are neutral. We see all-in yields as quite reasonable, but spreads are quite tight. We prefer investment-grade bonds with 5 to 7 years of duration to capture more yield. Be selective in US credit in technology sectors and avoid lower quality names with aggressive borrowing or uncertain AI monetization. We stay overweight alternatives for diversification, prioritizing managers with stable teams and strong track records. Gold, of course, is also an overweight, supported by safe haven demand and ongoing central bank buying. Of course, there are risks. A sharp US labor slowdown, AI spending overshoot without monetization, execution risk in China and Singapore reforms, and of course, finally, geopolitics can bring volatility back. But we think it's unlikely to have the same effect as Liberation Day. In summary, broaden your tilt towards EM Asia and Singapore, keep US quality and AI stocks that are the bottlenecks at the core, hold 5 to 7 years duration in bonds to capture more yield, be selective in credit, especially in the technology sector, and add gold and private markets as diversifiers. Thanks for watching. Take care. See you soon.